Kia ora, welcome to Shared Lunch, brought to you by Sharesies with Business Desk. My name is Ella Summers and I'm a journalist at Business Desk. Today we're talking about why exchange-traded funds have become so popular. Here to explain is Kanish, Chugh, the head of distribution at Global X ETFs. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Kanish. How is Sydney this morning?
It is very sunny, which is very surprising given the rain that we've had over the past few months. So it's nice, actually.
So, Kanish, I'm keen to know what got you into the world of ETFs and why you're so passionate about this field.
So ETFs, for those that don't know, it's an acronym that stands for Exchange Traded Funds. But essentially, just flip that acronym in reverse. It's a fund that is traded on an exchange. So it's a listed fund, essentially. Now, to a lot of people, that may sound scary, but it's actually not, because if you can trade a stock, it's very easy to then trade an ETF. And for me, that was really interesting, because what essentially an ETF does, it's a vehicle that has democratized investing. So it opens up many doors for many investors to access exposures that previously they couldn't do it all. You know, the business that I'm part of here, his legacy, we actually were the first business in the world to launch a physical gold ETF. So how else would you access physical gold? You'd buy, like go to the jeweler, go to a mint, actually buy gold, pay all those fees, not sure if that's going to be, the purity, is that 100% gold? Is it filled with alloy? What is it? And there was an ETF created in 2003 in Australia, listed on the Australian Stock Exchange, and that ticker is gold, GLD. And that's the idea. For me, that's really interesting. And so when I think about investors, I think about investment professionals, whether you're a financial planner, a stockbroker, institutions like pension funds or super funds, but then all the way down to my friends, my parents, my kids in the future. How would they invest? How do they want to enter the market if they have some money? And ETFs are a great way to do that. So that's really what triggered me and my interest. And it's been really interesting to see the journey that ETFs have taken here in Australia and the growth that we've had around the world.
What do investors need to consider or kind of keep in mind when approaching ETFs?
If I take my way back to when I started part of this business at Global X, we had, at that point, about 8 years ago, there were only about 50 or 60 ETFs. So in 8 years, we've gone from 50 or 60 ETFs to over 200. A lot were launched in the past few years. And investors need to be aware that the name of the ETF or the ticker, sometimes they're descriptors, but people should open up, go under the hood, really understand what's part of that ETF. Go on the product provider's website, the ETF provider's website, really see what that ETF is trying to give you exposure to and access to. ETF is just a vehicle. And I think we get caught up. It's a fund. It's like a managed fund. It's simply a vehicle that is making it easier for you to access certain types of exposures.
So if ETFs are the vehicle, are investors the drivers behind that?
Essentially, yeah, 100%. You essentially can now build your entire portfolio, especially in Australia as well, using just ETFs. And that wasn't something that was the case a decade ago or even 7-8 years ago.
Is it going to become more popular as well, having your whole portfolio made out of ETFs?
I think it will. I think it's been interesting to see the trends that we're seeing. I was having a look at some of the Sharesies data, actually, and to see some of it. So I think when looking at this in 2023, there are 6 ETFs in the top 20 securities that have been bought. So that's across your traditional stocks, both New Zealand, Australian, and US stocks, and ETFs. And there are 6 ETFs in that. So we're actually seeing a lot more popularity of ETFs in the general trading from investors. Now, why is that? I think there's a number of reasons. So one, it's the types of products and the exposures that are now available. If you've only got 5 or 6 ETFs that you can choose from, there's limitations there. You're not going to have that popularity. So there's more choice. So that's good. I think the understanding around what an ETF is. So people now understand, or a lot more people do understand. I think there's still more education that needs to be done, but a lot more people understand that an ETF is there. It's traditionally a passive, which means the design of an ETF is to track an underlying benchmark. So that's our job as a provider. Our job is to essentially ensure that that ETF tracks the benchmark that we state it will. So if it's gold, we hold physical gold. We hold over 27 tons of physical gold on behalf of investors. If it's the top 50 stocks in Europe, we will ensure that that ETF tracks that index that we're looking to track. And so for investors, they understand that now. So now the next step is, well, what's available to them? And so what we actually see is some investors that are entering the market now, especially, younger investors, sometimes their first investment is not a traditional stock, which historically, if I look at the Australian investor landscape, a lot of their first investments from 30 years ago, 40 years ago, if you were a first-time investor, you would have bought a bank or a miner. And now it may not be a stock, it may not be a company, it may be an ETF. And we've actually seen a greater adoption from investment professionals, which I think is the big part. So your financial planners, your advisors, your stockbrokers, and that then drives that understanding, that education as well. So it's sort of quite a cyclical in sort of nature of it.
Obviously, ETFs have been around since the early 90s. They've become more popular in recent times. Are they like the fastest growing investment instrument? There was 43 launched in Australia alone in the last year.
I think it's roughly around the number. There was a lot of ETFs that we saw last year, a lot of, Global X I think we launched eight of those last year alone.
Yeah.
Exactly. And we were actually the first to launch, crypto ETFs, for example, here in the market. So like a physical digital Bitcoin and Ethereum.
What was that like?
That was an interesting race, actually. It was an interesting journey because that took us nearly 5 to 6 years to launch those crypto ETFs. Obviously, there's a lot of regulation around crypto, but we wanted to launch products that gave investors a regulated structure around what is an unregulated asset class. Cryptocurrencies, it's unregulated, it's decentralized. That's the whole purpose of it. But for a lot of investors, and we've seen more recently with some of the, dramas that we've seen with some of the cryptocurrency industry and some of the companies that have collapsed and investors that have been stuck and hackings and things like that, and their wallets being stolen and hacked and whatnot. But I think here in Australia and around the world, actually, ETFs have grown exponentially over the past few years. Now, what are the reasons for that? I think you've got the issues that people have around traditional funds being very high fees, and ETFs are traditionally lower cost because they're tracking a index, which means they are going to have associated lower fees. I look at some of our fees. One of our ETFs, its lowest fee is 0.2%. Now, that's for a US Treasury ETF, so fixed income, but our gold ETF is 0.4% per annum. Now, when you think about if you were to go buy physical gold, or you talk about buying equities and some of the active fund managers and those managed funds, they can be as high as 1%, 1.5%. Some of them are charging performance fees. It can get very expensive. And so ETFs have traditionally been low cost, and that's really important.
Especially, I guess, for a beginner investor as well, like that must be quite attractive, but also to a more experienced investor, For some investments, there will be higher fees associated because of the exposure that it's investing into. For example, if an ETF is investing in emerging markets or Asia markets, Asia equities, Asia companies, you generally find that it may have a higher fee versus the US market because it is less expensive to invest in the US versus some Asian companies. When we talk about traditional funds, we don't have the level of choice that you have when you look at ETFs. I look at the Australian ETF market with over those over 300 ETFs that we have. You've got ETFs that can tap into certain thematics and certain sectors and certain countries. You don't get that same choice and range of products that you do with traditional funds. You also don't have that transparency. So with our equity ETFs, for example, you can know what that basket of stocks are. There's no secret sauce. There's no hiding behind a wall. We want to make sure we publish our portfolios daily. So anyone that wants to, whether you're an investor or not, you can go on our website and actually see what you're investing into or what that ETF actually invests into. When that index will change over.
So that's one of the reasons why you're able to charge lower, is you're not paying one or two people really high salaries to make decisions. You're not paying a big team of research analysts to make decisions. What you've done is you've actually chosen a benchmark or an index that is really strong, really structured. And we do that. That's our job, is to do that research, choose and do our due diligence.
How do ETFs compare to a portfolio of individual stocks, for example?
I'm not a financial planner, but I think you cannot be diversified if you're just investing in a portfolio of individual stocks. But what the ability that ETFs have done is they've given you the choice to go, well, I can invest in different asset classes. So I can invest in physical commodities. I can invest in cryptocurrencies. I can invest in fixed income, whether it's domestic, whether it's international fixed income, emerging market fixed income. You've got so much choice that you can be truly diversified within your portfolio, and you don't have to leave, a trading platform like Sharesies, for example. You can just do it all there. And that's really unique. It's really cool that, you have one place that you can do everything in. And I think what people also get concerned when you talk about portfolio of individual stocks, is it just New Zealand names as well? So are you just basically exposed to one market? That's a big risk, because we've seen what's happened in the past 2-3 years with how markets behave when they're faced with, global crises or central banks and interest rate decisions and all of these sorts of things. That market can behave differently. The US versus the Australian market. The US is really volatile. The Australian market has been pretty well safe in terms of, because of its heavy resource and mineral and commodity exposure. But still, there's been some volatility. The New Zealand market has had that volatility as well. But if you have that portfolio of individual names, if it's just exposed to one region, that's not diversified. So that's where ETFs can help to make your portfolio truly diversified.
It kind of seems like there's an ETF for just about everything. Are you able to give us kind of some examples of like the more weird or interesting or wild and wacky ones out there? Or what's the most kind of common theme across ETFs?
A thematic ETF is things like battery tech and lithium, or robotics and automation, or hydrogen or uranium, for example. That's a thematic ETF. It's trying to give someone exposure to a megatrend. Now, what is that? Now, a megatrend is something that is truly transformational. It is going to disrupt our life and disrupt our world. But what makes a megatrend different from a fad? And I think that's some of the wild and wacky ETFs that we've seen, because if a megatrend is long-term. It has to be, as I said, truly transformational, has to change, structurally has to be changing economies and changing how we live our life. And so when we think about megatrends, it needs to have government support, government policy support, corporate support. So look at battery tech, electric vehicles. 20 years ago, it was probably seen as a bit of a fad. There was no support. Their technology wasn't there. As the technology progressed and countries around the world started to think about emissions, governments started to implement, emission standards on petrol vehicles and diesel vehicles. They started to say, we need to have a phase out of these internal combustion engines and push towards electric vehicles. So all of a sudden you have government support. That government support then goes to corporate support. You start to see companies like Tesla really prosper. You start to see automobile companies like Mercedes, BMW, Ford, General Motors start to look at building out electric vehicles and starting to phase away from petrol. And they start to put dates on them. By 2030, we're not going to sell any petrol vehicles. We're going to only sell battery electric vehicles. And so that's the important part, is megatrends long term. And that's been a really interesting thing we've seen over the past few years, is thematics. But when you have thematics, you also have a lot of fads, a lot of interesting, wild and wacky ETFs. We don't see them in Australia because I think we're too small a market, but we do see them in the US. So an example there was around COVID. And I've used this example quite a few times, so apologies if anyone's heard this, but it's a WFH was a code for that ETF in the US, and it was a working from home ETF. Now, it was launched, I think, 2 or 3 months after all countries started to go into lockdown, so mid-2020. So really great timing. Obviously, in the US, the time to launch an ETF is a lot shorter. They basically, and the stocks in that ETF weren't bad companies. It was Microsoft, Zoom, DocuSign, all these companies that we use and we still use.
Yeah, and very much benefiting from the work from home.
Exactly. But that rationale doesn't necessarily stand 10 years or a 20 mega trend analysis. And that's the important part. To me, that was more short-term fad. I think there are some strong companies in that space, but that is not a long-term megatrend. To me, something like cybersecurity. And, we've got an ETF in the US, Bug, which focuses on the cybersecurity thematic and companies that are around that, or cloud computing, or, semiconductors. And you think about what we're doing here, you're, in New Zealand, I'm here in Australia, we're using our microphones and we've got, doing this VC. All of this technology is powered by semiconductor chips. So essentially they're the oil of the future. So you think about that, and we launched an ETF around semiconductors, and you can start to see interest in that because that's a long-term megatrend. In 50 years, you're still going to need semiconductors. In 50 years, we may not be working from home. We may be working from home, but there's concern around that. There's no government regulation really around that. So it's not a megatrend to me. So that's some of the wild and wacky ETFs that we see. But I think it's important for investors, when they're looking at those types of thematic ETFs, is to really research, is that theme a megatrend? Is it long-term? Is it transformational? Does it have government support? Then does that portfolio, does that ETF that we're looking to bring out really represent that theme? Just because it says robotics and automation on the name, does it actually do that? Does it actually give you exposure? Because we've seen some examples in the market here in Australia and around the world that it says something, but actually what it's doing is it's giving you company exposure to things like, say artificial intelligence and robotics ETF, and you start to have Google. Now, that's nice, but a lot of Google's revenue is ads. And actually, more recently, they've just started to turn a profit on their cloud computing company. But it's not artificial intelligence. It's a very small snippet of their revenue stream. So are you really getting the thematic, should you be buying an Alphabet or a Google to get exposure to artificial intelligence, or should you be looking at other types of companies that are associated really with that thematic?
That's so interesting. The research you must kind of uncover, because it's never ending.
It's never ending, and it's sometimes hard to define some of these thematics as well. That's, I think, the really hard part, because if I was to say to you, how do you define hydrogen as a thematic? What companies do you look for when you look at hydrogen? And that's the hard part and that's our job, by the way. So our
that's good to know.
Exactly, yeah. So and that's one of the things we're making it easier for investors. If they want to invest in hydrogen as a thematic, sometimes they have no idea what does it mean by hydrogen. Why is hydrogen a thematic? And yes, okay, hydrogen is going to be a sustainable, clean technology for the future, alongside battery technology and alongside uranium. It's all combining. We need not just one. We need a lot of different types of solutions. But what are the companies associated with that? Do you want the electrolyzers? So the companies that build basically the ability to turn, oxygen and water into green hydrogen. So the electrolyzer is that machinery, and that's what you need. And so you're looking for companies that are associated with that, but which ones are they? And where are they? And if they're based over in the UK, can I invest in them? Maybe that's not possible. Maybe it is, but it's hard. So that's where ETFs really can help.
Are ETFs becoming more country specific rather than global or regional in reach? And I guess what are the main differences between ETFs often in saying like the Australian market compared to the US market? What are kind of those differences?
So I think on that question around the Australian versus the US ETF market, because that will help answer probably the first question around country versus regional and global. The Australian ETF market is still, I'd say, a little bit in its infancy. We've only got around 300 ETFs available for investors, whereas in the US, there's a few thousand. That ETF market's been running for over 30 years. There's a lot more investors. They're a bigger market. And so they've got ETFs, as I said, like a working from home ETF or, ETFs. They've got some very wild and wacky ETFs over there. Whereas in the Australian ETF market, it's still growing and it's still in that sort of stage of development. So we don't have that wide range as yet, which is not a bad thing as well, because you end up with maybe too much nuances within that. What we do see here is we have choice at the moment on global. We have some regional exposures, and we have certain countries. We launched like an India ETF, which for investors, it's very hard to access the India stock market. But I would say it's probably, the big elephant out of Asia. It's basically where China was 10, 15 years ago. So when a lot of people invested in China, I think a lot of people will start to look at India as an economy, especially because of that consumption story. But there are still gaps in the market here in Australia. There's still more work that needs to be done with investors to make them understand as to what the ETF market can provide them for their portfolios. So in the US, I think you see ETFs dominate some of the trading of the top 10 charts and things like that. Here in Australia, it's not just there yet. So there's still some way to go. But I think one of the things when you're looking at regional versus global versus country, it comes down to how diversified your portfolio is and how large your portfolio is as well. Some investors only want to have 4 or 5 ETFs, and so it won't be a case that they will look at specific countries.
So yes, no matter what you're doing, diversification is key.
Yeah, exactly. It's key. So, but it's a case of depending upon how large your investment portfolio is as well. If you've got a very small portfolio, you may not want to have too many ETFs in there. So you may go more global in your choice because that gives you true exposure, but it's not as strategic because the way the European market works is different to the US market. The way the Asian market works is different to the Europe and the US market. And so for some investors, it's also good to understand what they're getting exposure to. So we talk about that idea of going under the hood. The idea is that if I looked at a global ETF, a global equity ETF, you're pretty much getting 60% America. You're getting 20% Europe, UK, or 30% Europe, UK, and the rest is sort of filtered around. Australia is 2% of that. So if you really want to then go overweight, say, Asia, or go overweight Australia, or go overweight New Zealand, you're going to have to do that by going that specific country or the specific regions.
If we kind of focus on the global market downturn that we're kind of currently at the moment, are ETFs more of a go-to in turbulent times? So
in the recent period, I think in 2022, generally, 2020 and 2021, we saw a lot of investment, a lot of people buying. In 2022, we saw a slowdown in people investing. We didn't see much selling across the broader market. I'm looking at some of the stats that you have from Sharesies as well, or from your platform, and that's been the case as well. A lot more people are sitting on the sidelines. They're not selling, but they're sitting on the sidelines in 2022. But what they were doing when they were looking at ETFs versus single companies or even managed funds is they were using ETFs because they've got price discovery. Now, what do I mean by that? So an ETF, when it's trading during the day, is essentially that is as close to, there's a third party called a market maker, which is a intermediary who basically creates the market for investors to buy and sell ETFs. And their job is to make sure that the ETF's price during the day is as close to the underlying benchmark that it's tracking. So what during really volatile periods is an ETF provides price discovery. So if I looked at a ASX 200 ETF, I'm actually can really be, confident that that ETF's price is as close to what its underlying benchmark is. Now, if I'm looking at a market that is closed during your trading hours, so say the US, I know there's a little bit of overlap between the New Zealand market and the US, but if there is that period where there is not that overlap, an ETF actually on a US equity product or a European equity or an India or whatever it is actually gives you that price discovery. You know what you're buying and the price that you're getting, and you know when you're selling. With a managed fund, you don't get that price discovery because you put in your order and it's generally 2 days later that you'll find out what price you were executed at. And when markets are really volatile, we've seen some days where markets have gone up 5%, down 5%. That can make a big difference to your portfolio, your investment. So ETFs provided that transparency, that true ability to know what am I buying, what's the price I'm buying at, or what am I selling and what price am I selling at. That's great. I think so. We saw a lot more investors use ETFs for that purpose. I think we also saw a lot more people use ETFs when they were saying, well, I'm sitting on the sidelines, but I still want to be exposed to the market. But I don't know if I should buy tech stocks. I don't know if I should buy banks. I don't know if I should buy commodities, airlines. What should I do? Well, let me just buy an ETF that's diversified, that basket. So ETFs were great for that as well. So that's, I think, what we've seen. And I think we've also seen, and from a Global X standpoint here in Australia, we've got two trading tool ETFs. So we've got a short and leveraged NASDAQ 100 ETF and a long leveraged NASDAQ 100 ETF. So think about it like it's a magnifying glass or a mirror on the NASDAQ 100 with some leverage. So it is basically allowing you to trade that volatility. They are for more sophisticated investors, but we've seen more investments into those types of ETFs during these really volatile periods. And I'm, looking at some of the stats that, Sharesies has provided, and I can see that our Global X Ultra Short NASDAQ 100 hedge fund, which is the code SNAS or SNAS, as we call it internally, that's starting to be used more popularly by investors wanting to trade around the volatility on that NASDAQ 100, for example.
Without giving financial advice, how many ETFs is reasonable to have? Can you have too many? Or, is there a perfect number? I feel like in the investment world, there's no perfect anything.
No, unfortunately not. There's no perfect number. And I think I alluded to it earlier in that it depends on the investor. It depends on their risk profile. So are they more conservative? Are they more aggressive? Do they want to be more tactical as well? And the other thing it depends on is the amount of money that they've got to invest in as well. So if you've got a smaller amount of money that you're wanting to invest, sometimes we see kids or parents setting it up for their kids and things like that. They go a bit more simplistic with only a few ETFs. You have more technical investors that will go quite large in the number of ETFs. I think that at the end of the day, it comes down to those factors. It also comes down to how much time an investor wants to spend. So, an ETF portfolio should be reviewed, like any portfolio should be reviewed on a sort of a timely basis, whether that's you put a set time, whether it's every month, every quarter, every 6 months, every year, or, based on other other metrics that you may apply. But that's really important because, say, for example, our gold ETF, the gold, if you buy our gold ETF when the gold price was, $22,000 Australian, and all of a sudden, because gold has had a rally, which, we've seen more recently, goes to 2,200, per ounce in Australian dollar terms. Well, that's paper. That's a paper gain. That's a paper growth. You need to rebalance that portfolio. So you may have said gold was, and if I look at gold traditionally in a lot of portfolios is between 2 to 5% of a portfolio, depending upon their risk profile. It's a defensive alternative. It's your insurance in a portfolio. So you're hoping that, if equity markets are really volatile, you have a lot of geopolitical events like the Ukraine conflict, etc. Gold has traditionally done well. But if that gold position becomes 10% of your portfolio, you should be aware of that and to go, well, do I need to take that back to being 5%? Or you may at that point make a decision and go, no, I'm happy for it to be 10%. But you need to, as an investor, make that decision. So, having X number of ETFs, whether it's 5 or 10 or 15 or whatever it is, comes down to your risk profile, how much money you have to invest in, but also how frequently you are looking to rebalance that portfolio, because the weight of the portfolio at the start changes as the markets move as well. So what we actually see is a lot of people use some very plain, I would call them traditional, simplified ETFs as their core. We've got some ETFs that are available that are multi-asset. So basically, they're essentially equities, fixed income, alternatives all in one. So it's one trade, gives you everything, a multi-asset ETF. We've seen popularity of those start to increase. So what we do see sometimes is investors take that as the majority of their portfolio, and then the remaining percentage of their portfolio, they start to be a bit more tactical, or they look at certain specific thematic ETFs, single stocks, other types of investments to complement. So the satellite, so that core satellite approach is very common. It's the common way we see financial planners build portfolios. They have a core and they have a satellite. And that core idea is to be, whether it's just tracking the market or being a bit more simplified, to then allow you to take a bit more risk with your satellite exposure. So that is another alternative, which is when you see sometimes more ETFs being used.
That makes sense. How does like a company's share price, how is it impacted by being included in an ETF? Or it isn't, it is? Take me through it.
So we put into place certain safeguards to ensure that when a company gets included in an ETF, we're not buying too much of that company so that we don't want to influence the share price. I think that's the important part. We don't want our ETF's underlying index decision to include X company over Y to influence that company's share price. I think there are some indexes, some ETFs historically that have done that. And I think in New Zealand, there has been that case that occurred. There was a provider's clean technology ETF that didn't have those safeguards in place. And that's the ETF provider's job, when we're developing a product, to ensure that the ETF that we're looking to build is liquid. People can buy and sell it, and there's no issues around that. But also there are safeguards around how much of a company will we own. We don't want to be in a position where we're owning 50% of a company, because that makes it really hard for us. One, it influences that share price, but when we need to buy more or sell more, that could be really difficult. And there are also the regulatory hurdles and I guess the regulations around how much of a company you can own as well. So we make that our job when we develop an index or develop an ETF to ensure that we've got those safeguards in place, because we don't want that to happen. It has happened historically. We have seen it. The ETF market and industry is only 30 years old. So naturally, there's going to be instances where we've seen that, and there's learnings that we take from that to ensure that we don't influence a company's share price.
What happens when an ETF closes then?
I have been part of a few instances where we've had to close ETFs. And what would happen there is just all the money that's in that fund gets distributed back out to the investors if they've held on to that fund at the time of the closure. And that just gets given back out to them based on how many units they held.
Quite quickly, what development will we see in the future for ETFs?
I think in the Australian and the New Zealand market, we're going to see more development. We're going to see more growth. We're going to see more competitors and players come out into this space. Global X entered the Australian space last year by acquiring a previous provider, and we rebranded that provider to Global X in October. So you're going to see more ETFs come from us. There's still gaps in the space. So what we will see is, some of the ETFs that we've recently launched. We launched an Australian equity ETF that was the Australian equity market, X financials, X energy, X resources. Now that was unique in the market because the Australian Australian equity market, company market, is dominated by banks and miners and energy. So if those investors that have exposure to those individual companies, they want exposure to everything else, how do they do that? So we launched an ETF called AusXX, is a ticker. But that's sort of the thing that we're going to look to do. I think there will be some growth both in the New Zealand and the Australian market. I think by 2020, by 2025, we could have the Australian ETF market right now is about 140 billion Australian dollars. I'm going to say by the end of 2025, it could be about 200 billion Australian dollars, and we could have close to 400 ETFs available as well. Now, that's a lot, because we've already got over 300. It's about 303, 304 at the moment. But there will be more ETFs. Again, that's great at the moment because there's still gaps in the market. But that's what we will see. I think the other thing we will see is more understanding and education. The fact that we're doing this podcast around this just shows that there's interest.
Perfect. Oh, well, that's a wonderful way to end the podcast. Thank you so much, Kanish, for coming onto this episode and answering all our weird and wonderful questions about the weird, wonderful world of ETFs. But yeah, super appreciate your time.
No, thank you for having me.
Thanks for tuning in, everyone, and a big thanks to Kanish for joining us. We really appreciate your time and insights. We have a special offer for Sharesies investors from Business Desk. If you use the promo code SharedLunch2023, you'll get $100 off an annual subscription to Business Desk, which is usually $249, including GST. The offer only applies to new Business Desk subscribers, can only be used once per subscriber, and can't be used with any other discounts. That's all from us this week. Enjoy the rest of your week.